The final section of the cash flow statement deals with the changes related to how management finances the business. This includes typically two main areas of finance: debt finance and equity finance. Let's start with debt finance. On the debt side, cash is going to increase whenever a company borrows money, and cash is going to decrease as that loan or debt is repaid. Now, remember that payments associated with debt can be both principal payments, but they can also be interest payments or a combination of both. In this case, we can see borrowing in year one brought in $50,000 of cash. So it's a cash increase or a cash inflow, which is why it's shown as a positive number. However, when we look at year two, the company actually paid off the loan, leading to a cash decrease of $50,000 or a cash outflow, which is why it's represented by a negative number. Let's now turn to equity finance. Cash is going to increase when a company issues shares for cash. And cash is going to decrease if it repurchases those shares or if the company pays out dividends. When a company issues shares for cash, this will be shown as a cash inflow, which is a positive number, while if the company repurchases shares or pays out dividends, these are both cash outflows and they're going to be shown as negative numbers. Here we see no issuance or repurchase of shares in either year one or year two, but the business has paid a dividend both years, which is why you see these both as negative cash outflows. Let's look at the third and final section of the cash flow statement, and that's cash flow from financing activities. When we talk about financing, we're talking about really how is the organization or business funded. A business might be funded through equity or through loans from the bank, like debt finance. And we need to think about the direction of the cash flow. So if an organization or business borrows money from a bank, that's a cash inflow. When it repays the loan, that's a cash outflow. When a company issues new shares, that's a cash inflow, but a company may buy back shares from its shareholders, and that would be a cash inflow. Part of financing as it relates to equity also involves paying dividends. So we'll capture dividend payments also under financing activities. So let's actually build this out, and then we will complete the cash flow statement. So what we have is we need to look at what's happened with debt. A repayment of debt is going to be a negative number, a cash outflow, recall. So when we go down to our long-term debt, you may recall when we did the activity, we repaid 100 of the loan in year two. So that's going to be a cash outflow of 100. Now let's look if anything happened to equity. So I'm going to go back to the balance sheet. I'm going to look at row 70. And you can see that our common shares haven't changed. So we neither issued new shares or bought back shares. So there, we're going to just be able to type in a 0. But you may recall we did pay a dividend of 5, and that's a cash outflow. I'm just going to link that. I'm going to go to the bottom of the income statement. There's the dividend in row 103. I'm going to hit enter. So we have 3 cash flows. Although in this case, there were only 2, they were both outflows. So I'm going to just sum that up. So we have a positive cash flow from operations of 28, no cash flows in or out related to investing activities this year. And then we have a cash outflow as it relates to financing activities. Let's sum those 3 together. So that's the 28 plus the cash flow from investing of 0, plus the cash from financing of negative 105. We then need to just put in our opening balance. And that means our closing balance is 419. In other words, what we're saying is we started the year with 496, but there was a net cash outflow of 77, which means our cash balance at the end of the year was 419. Let's do one final check, because always the cash flow balance at the end of the year needs to match what we have on the balance sheet. Let's make sure we have 419 there. And if we go to row number 47, yep, we've got it. We did our cash flow correctly because it matches the cash flow, or the cash, I should say, on the balance sheet. Now what we're going to do is we're going to calculate a cash flow statement again. I'm going to show you a slightly different format that you may find easier to understand or easier to complete. Now, I've called this activity or this company Ravensburger Inc., but if you look closely at the numbers, they're actually the same as Cobble Hill. I've just laid out the income statement, balance sheet, and cash flow in a different order, which is going to allow us to build that cash flow and always have sight of the income statement and balance sheet. Now, the instructions also are at the top. So I'm going to encourage you to go work through this with me. Following those instructions, feel free to speed me up or slow me down. And then there's another activity that's similar called Springbok that I want you to have a go on your own, and then I'll debrief with you. So let's actually, the first thing it says, calculate the differences on the balance sheet. What I often like to do is actually have a column where I'm just calculating the differences. So with all I'm going to do is actually take the current year and I'm going to subtract the previous year. And I'm going to go Control C and Pay Special and just the formula. And then I'm just going to hit F4 and I'm just going down all the items. This is just going to save me a bit of time as I go to the cash flow statement. So now what I'm going to do is I'm going to start with net income. And I'm going to link that to row 29. That's E29. You know, we add back depreciation, and that's going to be E22. Now, the change in accounts receivable, remember, we have an increase of 70 for accounts receivable and an increase of inventory. And when those assets increase, it means less cash. So we have to make sure those are cash outflows. So now I'm just going to put a minus sign, minus 70, and I'm going to copy that down, Control D. With accounts payable, we know that accounts payable has increased by 20. That means we've kept cash that we would otherwise have to pay to suppliers. So that's a positive number. So I'm going to go plus and select the 20 there. I'm going to sum it up. And we have our cash from operations. Now, recall that we need to calculate the property, plant, and equipment. And recall that we did this together. I'm just going to zoom in just so you can see it more. Remember, the formula was actual equals PPE at the end of the year minus depreciation, which is adding it back because we're minusing a minus the opening balance. And we know that, whoops, apologies there. Let me just get a bracket. We know that's 0. But we're going to link that into here, and we're going to make sure there's a negative sign there, recall, because it's a cash outflow. And I'll sum that up. Now what we can do is we can look at issuing of long-term debt or repayment. You can see our long-term debt is down by 100, so I'm just going to, I can just link that right in because it's cash outflow. I can see there is no change in equity. And I can see that there's a dividend. I'm going to go over to the income statement. Remember, there was that dividend of 5. I sum that up. We know what our net increase or decrease is by just adding up cash from operations plus cash from investing plus cash from financing. We know our opening balance of cash was 496. And we know, hopefully, that we get our closing balance of 419. I've put a little check here because, again, the neat thing about doing your financial statements this way is that you know you've got your cash flow right when at the very bottom, your closing cash balance matches the cash that you have on the balance sheet. So now I want you to have a go. There's a very similar exercise with new numbers where you do the same thing and see how quickly you can build a cash flow. And then I will debrief it with you. Okay, see you in a moment. Let's practice one more time. Now, hopefully you've already had a go and you can check your numbers with mine or follow along with me. So let's get going. Again, the instructions are at the top. I typically like to calculate the differences first. And I'm just going to go year 2 minus year 1. I'm going to go Control C and Pay Special. Here's the formulas. And then I'm hitting F4 to repeat. And I'm just going to quickly go down all the line items on, or the accounts on the balance sheet. That just is going to save me some time. I still have to make sure I get some of my signs, the negative and positive, the cash inflow and outflow the right way. But now let's build that net income, cash flow statement starting with net income. Now, net income is on, obviously, the income statement. We know that net income is 2,584. We know we're going to add back depreciation, and that depreciation is 319. Now, I've already made a mistake because I need to make sure that's a positive because I'm adding it back. So I'm putting a negative sign there. Now we have a couple of other things. We have something called unpaid taxes. And what happens here is our unpaid taxes have gone down, which means that's been a cash outflow. So I'm going to capture that as a negative 43. Right? We have, because it's gone down, we know that we paid more taxes. Our change in accounts receivable has gone up. So that's more money tied up with customers. So recall, we're going to change the sign there. That's going to be negative 540. And our inventory has gone up by 193. So that's also cash that's tied up in inventory. So that's a negative number. And our accounts payable has gone up. And we know that's a positive number because that's money that we otherwise would have paid to our suppliers. I'm going to sum that up. We get 5,394. Now we're going to do the same thing with our PP&E. I'm going to zoom in here so we can see the balance. And what we're going to do is we know that the PP&E at the end of the year was 26,193. We know the depreciation. We know the PPE at the start of the year. And so we're going to use the same formula equals end of year minus depreciation, really add back depreciation, minus the opening balance. Here we do have capital expenditure of 3,420, but recall that's a cash outflow. So when we put it in the cash flow above, we're going to put a negative sign. And now I'll zoom out again just so we see a bit more. Great. And I know there's only one item, but I'll sum that up. Now what we need to do is see what's happening with our debt and our equity and dividends. Those are financing activities. So our short-term loans have been repaid. They've dropped, so that's a cash outflow of 339. Our long-term debt has also been repaid, so that's a cash outflow of 812. Let's look at our equity. Our equity, as before, let me just scroll down here, hasn't changed. So I'm just going to link that to here. And we have paid a dividend. Let's just check what that dividend is of 1,397. That's a cash outflow, so that stays as a negative. We can sum up the financing cash flows. Now let me just zoom out a bit more. I'm going to make sure we can see this in a bit more detail. Okay, now what we want to make sure is, of course, now when we sum this up, it matches the cash on the balance sheet. So we are going to, first of all, take our cash from operations together with our cash from investing, together with our cash from financing. Our opening cash balance is 3,746. That's J15. And I add that up, and I'm hoping to get 3,172. I did, and I have a check message there that's confirming that I've done my cash flow correctly because it matches the cash on the balance sheet. Hey there. Thanks so much for joining me for this course on accounting fundamentals. I truly had a blast showing you the ins and outs of the income statement, balance sheet, and cash flow. But that's not all. We also covered how to build up those financial statements from scratch by recording individual transactions. And one of the coolest things I think we covered was how a single transaction can impact all three financial statements. Trust me, accounting will pop up all the time in other CFI courses. And that's because accounting is truly at the heart of so many careers in finance. Thanks again for joining me, and I hope you left with a solid foundation in accounting.